All right, so let's dive into something that I think has been making headlines
Mm-hmm.
and probably hitting your wallet pretty hard lately.
Yeah.
Inflation. We're going to unpack what the experts are really saying about where it's headed.
Okay.
And more importantly, what it all means for you.
Okay.
Think of this as your personal decoder ring
I like that.
for all the inflation jargon and a roadmap for navigating these uncertain economic times.
I like that, a decoder ring.
Yeah?
Yeah, because you're right. There's a lot of noise out there about this.
Yeah.
We're going to sift through insights from economists and financial experts to help you cut through that noise and make smart decisions for your own financial life.
Okay, so first up, we've got the economists predicting that we probably won't see inflation hit that 9% mark again, like it did back in 2022.
Right.
What's their reasoning there?
Yeah, their argument is that today's economy is just wired differently than it was back then.
Okay.
It's older and less prone to those sudden bursts of spending and price hikes that can fuel inflation.
Okay.
Think of it like a seasoned marathon runner. Okay.
They've got a steadier pace compared to someone just starting out who might sprint and then burn out quickly.
So we're not as likely to see those wild spending sprees that can really send prices soaring.
Yeah.
That's reassuring.
Yeah.
But we're definitely not out of the woods yet, right?
Right, and this is where Neel Kashkari's perspective comes in.
Okay.
He's the president of the Federal Reserve Bank of Minneapolis.
Okay.
And he's also expecting inflation to keep cooling down throughout the year. He's even pretty confident that the Fed can steer inflation back down to that 2% target they aim for.
That's good to hear.
Yeah.
But the Fed's been raising interest rates to combat inflation, and that's got a lot of people worried.
Right.
Kashkari actually broke down why those long-term interest rates have been rising, and it's kind of a two-part story.
Yeah.
Okay.
He attributes about 30% of that increase to something called inflation compensation. Now, that sounds complicated,
It does.
but it's basically the extra return investors demand because they're worried about inflation eating away at their earnings.
Right. Think of it like this. If you lend someone money and you know prices are going up,
Right.
you'll want them to pay you back a little extra to make up for the fact that your money won't buy as much in the future.
Okay, that makes sense. So investors are basically pricing in that inflation risk.
Exactly.
But what about the other 60% of the interest rate increase? What's driving that?
That's where things get a little trickier. The remaining 60% is tied to real rates,
Okay.
which are affected by things like economic growth and what investors expect to happen in the future.
All right.
The problem is there's a lot of uncertainty around what economists call the neutral rate, the rate that neither speeds up nor slows down economic growth.
Right.
It's kind of like trying to find the perfect temperature setting on the thermostat.
Okay.
You don't want it too hot or too cold, but it can take some tweaking to find that sweet spot.
So we don't even really know what the ideal interest rate should be right now?
Right.
Yeah. No wonder everyone's a bit on edge.
Exactly. And to add another layer of complexity, we have to consider things like government spending and taxes,
Right.
which all fall under fiscal policy. These can impact what's called the term premium, which is the extra return investors want for holding on to investments for a longer period. It's like a reward for being patient and tying up your money for a longer time,
Right.
especially when there's more uncertainty in the market.
Okay, so there are a lot of moving pieces at play here.
Yes.
With all this talk about interest rates, it's easy to forget about the real-world impact on jobs.
Yeah.
Kashkari pointed out that the January jobs report showed an unemployment rate of 4%.
Yeah.
What's the significance of that number?
Well, it's just that the labor market is still strong, even though it's cooled down slightly. Now, this might seem counterintuitive, but a slight cooling in the job market could actually help ease inflation.
How so? I would think more jobs would be a good thing for everyone.
It is, generally speaking.
Right.
But when the job market gets too hot, employers have to offer higher and higher wages to attract workers. And to cover those increased labor costs, businesses often raise prices,
Yeah.
which can feed into inflation.
So a bit of a slowdown in the job market might actually help prevent prices from spiraling out of control.
Exactly.
Interesting. Now, I know Kashkari also touched on tariffs in his interview.
Yeah.
What was his take on those?
He's urging caution on that front.
Okay.
He's basically saying, hold on, let's get more information before we start making big changes. It seems he's a fan of stability and avoiding any rash decisions, especially when the economy is in a relatively good place.
Yeah, why rock the boat unnecessarily? Right.
Exactly.
It sounds like he's really trying to take a measured approach to all of this.
Yeah.
But I know he also expressed some concerns about factors that could make inflation harder to predict.
Right. And this is where he brought up something called residual seasonality,
Okay.
which I know sounds like a mouthful.
It does. Can you break that down for us?
Basically, it's a pattern where we see higher inflation pop up in the first quarter of the year. Think of it like how certain fruits and vegetables are only available during certain seasons. It's kind of like that, but with inflation.
Okay.
And this pattern has economists scratching their heads because it's not entirely clear why it happens.
So it's like this weird seasonal inflation bump that we just can't fully explain.
Exactly. But here's the interesting part.
Okay.
Despite this concern about residual seasonality, Kashkari is actually quite optimistic overall. He thinks that if we continue to see that downward trend in inflation and we don't get that first quarter bump, we could be in for a period of rapid disinflation in the first half of the year. Disinflation basically means inflation is slowing down, so prices are still rising,
Okay.
just not as quickly.
Okay, so he's saying if we can just get past that potential first quarter hurdle,
Right.
things could actually look pretty good on the inflation front.
Yeah.
That's encouraging. But what happens if inflation does come down as expected?
Yeah.
Wouldn't the Fed want to keep interest rates high just to make sure inflation stays under control?
That's where things get even more interesting. Kashkari has actually hinted that he'd be open to cutting interest rates if inflation drops quickly,
Wow.
even if there's still some uncertainty about other economic policies.
Okay.
He argues that if inflation is clearly on its way down, there's no need to keep those higher interest rates in place.
So potentially lower interest rates down the line.
Yeah,
That would be welcome news for a lot of people, especially
Yeah.
those looking to buy a home or start a business.
absolutely. But as with everything in economics,
Right.
there are different viewpoints.
Okay.
Some economists believe the Fed should be less influenced by things like government spending and tax decisions,
Right.
especially when a new administration takes office. They worry that the Fed might be tempted to keep interest rates lower than they should be
Okay.
to accommodate those new policies, even if it risks higher inflation down the road.
Right. It's like trying to balance short-term gains with long-term stability.
Exactly. And Kashkari has a counter-argument to this. He points out that the Fed's current approach is shaped by that recent surge in inflation, which caught many people by surprise.
Right.
Given all the geopolitical uncertainties in the world right now, he believes it's crucial to be mindful of the potential for another inflation wave driven by supply chain issues or global events.
That makes sense. We've all seen how fragile global supply chains can be,
Yeah.
and any disruption could easily send prices soaring again. So it sounds like the Fed is walking a tightrope between trying to support the economy and keeping inflation in check.
Yeah.
They're open to cutting rates if things improve, but they're also keeping a watchful eye on those potential risks that could send inflation back in the wrong direction.
That's a great way to put it. Now, while Kashkari and the Fed are focused on the U.S. economy, let's shift gears for a moment
Okay.
and look across the pond at what's happening with the Bank of England. They're actually taking a more cautious approach, even though some people are expecting them to cut interest rates soon.
Why is that? Aren't they seeing similar trends with inflation?
They are, but they're expressing concern that cutting rates too quickly could actually make things worse.
Oh.
They're worried that trying to stimulate growth in an environment with low productivity, meaning we're not producing as much output per worker, could lead to even more inflation.
So they're prioritizing controlling inflation over stimulating growth.
Yes.
That's a pretty clear signal.
It is. They're basically saying, hey, we need to be really careful here. Cutting rates might seem like the easy solution, but it could backfire. We've been talking about inflation from this big picture perspective, interest rates, government policies, global trends. But I'm sure you're wondering, how does all of this translate to your everyday life? What does it actually mean for your wallet?
Exactly. At the end of the day, it's about how this impacts our ability to buy groceries, pay our bills, and maybe even have a little fun without breaking the bank.
Right. So let's get down to brass tacks. Let's say inflation does continue to cool down, as many of these experts are predicting. What could that mean for you on a practical level?
Well, for starters, it could bring some much-needed relief at the grocery store.
Yeah.
Maybe those steadily rising prices finally start to level off. Or even, dare I say it, come down a bit.
I like your optimism. And beyond just groceries, it could mean your money goes further overall.
Yeah.
If your income stays the same but prices are dropping,
Right.
you're essentially getting a raise without even asking for one. You can buy more with the same amount of money.
That would be a welcome change after feeling like our paychecks have been shrinking for so long. What about those big purchases people put off during high inflation, like buying a home or a car?
That's where the potential interest rate cuts come in. If the Fed decides to lower rates, it could make those big purchases more affordable. Lower interest rates mean lower monthly payments, which can make a huge difference for people who are stretching their budgets.
Okay, so lower inflation could mean more breathing room at the grocery store, a boost to our purchasing power, and even a chance to finally make those big purchases we've been putting off. But let's flip the script for a moment. What if inflation turns out to be stickier than expected? What if those prices just keep creeping upwards?
That's the scenario we need to be prepared for as well. If inflation remains high, it means the value of your money is constantly being shipped away. What you could buy with $100 today might cost you $105 or even $110 a year from now.
That's a scary thought. It's like this invisible force is constantly working against you, making it harder and harder to get ahead.
That's a great way to put it. And it's why it's so important to be proactive and have a plan.
So what can people actually do to protect themselves from inflation, whether it cools down or stays stubbornly high?
Yeah.
What are some practical steps they can take?
One of the most crucial things you can do is make sure your income is keeping pace with inflation. Now, this might mean asking for a raise, negotiating higher rates with your clients if you're freelancing, or even exploring new income streams. The gig economy offers a lot of opportunities these days.
Right, because if your income isn't growing at least as fast as inflation, you're essentially getting a pay cut every year without realizing it.
Exactly. Now, beyond income, you also want to make sure your savings are working as hard as they can for you. Leaving all your money in a traditional savings account that offers tiny interest rates means inflation is slowly eating away at your savings over time.
So we need to find ways to make our money grow faster than inflation is eroding it. But how can the average person do that?
There are definitely options. You might consider investments that have historically outperformed inflation, like stocks or real estate. Now, I know those can seem intimidating, especially if you're new to investing.
Right. And they also come with risks. So it's important to do your research and figure out what level of risk you're comfortable with.
Absolutely. You don't want to jump into anything without understanding the potential downsides. Talking to a financial advisor could be a good move,
Okay.
especially if you're feeling overwhelmed or unsure where to start.
That's a great point. Having a professional in your corner can make a big difference, especially when it comes to navigating these complex financial waters.
Now, beyond income and investing, there are also some everyday habits you can adopt to combat inflation. It might sound simple, but becoming a more mindful shopper can make a real difference. Pay close attention to prices, compare different brands and stores, and don't be afraid to shop around.
Yeah, it's easy to fall into a routine and just grab the same items week after week. But with prices fluctuating so much, it really pays to be a savvy shopper.
Exactly. And think about those non-essential expenses. Can you cut back on those lattes or restaurant meals?
Yeah.
Can you find free or low-cost alternatives to some of your usual activities?
Right, maybe it's cooking more meals at home, exploring those free events your community offers, or even getting together with friends for a potluck instead of always meeting at a restaurant. Those small changes can really add up over time.
Absolutely. And don't underestimate the power of negotiating. Can you negotiate a lower rate on your cable bill or your cell phone plan? It never hurts to ask.
So it's really about taking control and being proactive. We can't just sit back and let inflation happen to us.
Yeah.
We have to find ways to fight back.
That's the spirit. Remember, knowledge is power. The more you understand about inflation and how it impacts your life, the better equipped you'll be to make smart choices.
Okay, so we've talked about strategies for dealing with both scenarios, if inflation keeps falling and if it stays high. But is there any way to get a clearer sense of which scenario is more likely? Can we glean any clues from the expert insights we've discussed?
That's the million-dollar question, isn't it? Unfortunately, economics isn't as precise as, say, predicting a solar eclipse.
Right.
There are so many variables at play. It's impossible to say for certain what will happen.
Right. We can't just gaze into a crystal ball and get a definitive answer.
Right.
But I guess that's part of what makes this whole topic so fascinating.
Yeah.
It's like a puzzle we're constantly trying to solve, weighing the evidence and trying to make the most informed decisions possible.
I love that analogy.
Yeah.
And it highlights an important point. Even the experts can get it wrong sometimes.
Yeah.
No one has a perfect track record when it comes to predicting the economy.
So what's a listener to do with all of this information swirling around? How can they cut through the noise and figure out what truly applies to their own situation?
That's a great question, and it brings us to a really important point about personalizing this information.
It's easy to get lost in those big economic forecasts and wonder, okay, but what does this mean for me? How does this actually impact my life?
Yeah, It's like trying to plan a picnic based on a national weather forecast.
Right.
You need that hyper-local, personalized perspective.
Exactly. So how do we take these expert opinions on inflation and actually apply them to our own financial lives? Where do we even begin?
First, think about your individual financial goals.
Okay.
Are you saving for a down payment on a house? Trying to pay off student loans? Building a nest egg for retirement? Those goals are going to influence how you react to these different economic scenarios.
Right, because the same inflation rate could have a very different impact depending on your personal circumstances.
Exactly. If you're saving for that down payment
Right.
and interest rates drop, you might reach your goal faster. But if inflation remains high, you might need to adjust your savings plan and contribute even more each month to stay on track.
So it's almost like creating a personalized inflation strategy
Yes.
based on your unique situation.
I like that in an inflation strategy. It's about taking this big picture economic data and turning it into an action plan for your own life.
Now, we talked a lot about how inflation affects our spending and saving habits.
Yeah,
But it can also play a role in our investment decisions, right?
absolutely. Remember those investments we discussed that tend to do well during periods of inflation, like stocks or real estate?
Right.
Well, if inflation cools down, those riskier assets might become less attractive to investors.
Because the potential return might not be as high if inflation isn't eroding purchasing power as rapidly.
Precisely. On the other hand, if inflation stays high, investors might flock to those investments that are seen as hedges against inflation, potentially driving up their prices.
So it's this constant dance between risk and reward. And inflation is a major factor in determining the steps.
That's a fantastic way to think about it. And that's why it's so important to stay informed, educate yourself, and be flexible. Your investment strategy should evolve along with the economic landscape.
So much of this comes down to being proactive and adaptable.
I couldn't agree more. Don't be passive. Don't let inflation just happen to you.
Right.
Take charge of your finances, make a plan, and be ready to adjust course as needed.
It's all about empowerment. We have the knowledge now, thanks to this deep dive.
Yeah.
And that gives us the ability to make informed choices.
Exactly. That's what we're all about, equipping you with the information and insights you need to navigate these complex economic times.
And on that note, we'll wrap up our deep dive into the world of inflation. Remember, you have the power to take control of your financial future. Keep learning, keep asking questions, and keep diving deep.